Imagine sitting on like $500 billion. It's yours. I mean, it is legally contracted to you.
Right.
But you are somehow losing money every single day.
Yeah.
Your cash flows is bleeding into the red, all because you physically cannot build the computers fast enough to actually collect that money. You just, you have to sit there and watch the backlog grow.
It sounds like, a theoretical business school puzzle or something.
Exactly.
But it is the terrifying reality for the biggest tech companies on Earth right now.
Welcome to the deep dive. Today, we are looking at an incredible stack of sources that really pull back the curtain on the artificial intelligence race. We've got this in-depth macro conversation featuring Jordi Visser on Anthony Pompliano's show, and we're mixing that up with some very sobering, like fresh macro market data from 42 Macro.
Yeah, the data is wild.
It is. Our mission today is to connect the dots for you. We're going to trace a line from the explosion of AI to the massive global capital required to fund it, to the rollout of physical robots, straight into a looming squeeze in global liquidity.
The goal here is to take you from the theoretical end of capitalism, which we hear a lot about, to some very real flashing red warnings in the bond market.
Right.
Because the technology doesn't exist in a vacuum, It has to be paid for.
Okay, let's unpack this. The idea that capital, not energy, is the real AI bottleneck.
Yeah.
Because every article I read says, oh, we're going to run out of electricity, or we're going to run out of specialized microchips.
Sure.
But Eric Schmidt, the former CEO of Google, is arguing that the true bottleneck is just cold, hard cash.
He is. And, to understand why, we really have to look at the sheer scale of what is being built right now.
Yeah.
The narrative has heavily focused on the power grid and the silicon, but Schmidt points out that the true existential constraint is the capital required to actually buy that compute power and energy up front.
Which brings me back to that $500 billion number from the intro.
Right, Google.
Let's look at Google. The sources point out they just posted their first negative free cash flow quarter.
Yep.
If you just read the headline, you'd panic. You'd think, oh man, Google is failing. But then you look at their backlog.
It's massive.
They're sitting on a $514 billion backlog of contracted cloud orders. But they can't monetize those contracts until the physical data centers are built.
Because building those data centers requires massive upfront capital expenditure. We call these companies hyperscalers.
Right, I hear that term all the time. But what exactly is a hyperscaler, like in plain English?
A hyperscaler is essentially a company operating data centers and cloud computing infrastructure on a massive global scale.
Okay.
We are talking about Google, Amazon Web Services, Microsoft Azure. They are basically the landlords of the internet.
Got it.
And right now, they have to spend tens of billions today to realize that revenue tomorrow. If they don't spend it, they just don't get to collect that $514 billion.
I still don't totally get why they have to spend it all right now, though. I mean, why not just build a few data centers, collect the revenue, and use that cash to build the next batch?
Right.
It feels like this massive existential game of high-stakes poker, where they are shoving all their chips into the middle before they even see the flop.
It is, because of the scaling laws of artificial intelligence. In this space, the winner takes almost everything.
Okay.
If Google decides to build slowly and prudently, a competitor will just build faster. And because AI models get exponentially smarter the more compute you throw at them, the competitor's model will be vastly superior by the time Google finishes building.
Oh, wow. So the product you're trying to sell would be obsolete before you even plug it in.
Exactly. What's fascinating here is how this dynamic shifts when we look globally, particularly at the open source threat from China.
Yes, the sources spend a lot of time on DeepSeek, the Chinese open source model.
They do.
They have somehow managed to catch up to the frontier models despite not having the same access to the massive U.S. compute infrastructure. I thought compute was the whole ballgame. How are they even competing?
They are achieving it through what the sources call algorithmic efficiencies and structural differences.
Hold on, you say algorithmic efficiencies, but what does that actually look like under the hood? Are they just like writing cleaner code?
Think of it like this. If you have a massive unlimited engine...
Like the U.S. hyperscalers do.
Exactly. You can afford to have the slightly inefficient transmission. You just brute force the speed.
Right.
But if your engine size is restricted by hardware bans, you have to engineer the most perfectly efficient transmission possible to get the same speed out of the car. DeepSeek is optimizing the actual math of the neural networks, so they require fewer microchips to train and run.
Okay, that makes sense. Necessity breeds invention.
But the source material highlights a critical philosophical difference that goes beyond just the code. It's about the ultimate goal of the enterprise.
How so?
While in the US, labs like OpenAI and Anthropic are ultimately building commercial enterprises. They are creating enterprise APIs, consumer products. They have to worry about revenues, profit margins, and eventually going public.
Right, they're trying to build a moat in a capitalist system.
According to the sources, the CEO of DeepSeek has a completely different North Star.
Oh.
DeepSeek operates much more like a missionary project. Their stated sole goal is to achieve artificial general intelligence.
Just AGI.
Just AGI.
Yeah.
They've explicitly stated that consumer products, enterprise revenue, and market share are simply byproducts. They aren't trying to maximize profits in the traditional Western sense.
And they have serious financial backing to pursue that mission without worrying about quarterly earnings, right?
Yeah.
The Chinese government recently injected, what, $9 billion into their innovation markets to support this kind of technological advancement.
Yeah, and we should be clear here. We are just observing the data from the sources. We aren't taking a side on which economic system is better.
Of course.
We are simply reporting that these are two fundamentally different national strategies for funding the AI race.
Yeah.
The U.S. relies on deep private capital markets. Google issuing equity, startups raising venture capital. China is utilizing state-directed capital to ensure their models stay neck and neck.
Which perfectly illustrates why capital is the bottleneck.
Yeah.
But eventually, all this software has to interact with physical hardware. You can't just code your way out of physics.
No, you absolutely cannot.
The sources brought up this amazing analogy that I absolutely love.
Oh, the movie one.
Yes. It compares the current state of AI to the Adam Sandler movie 50 First Dates. For anyone who hasn't seen it, Drew Barrymore's character wakes up every day with her memory completely wiped.
Right.
Current AI models basically suffer from that exact same daily amnesia. You can have a brilliant conversation with a chatbot, but when you start a new session, it has no idea who you are.
Yeah.
To fix this, to create true AI agents that actually remember your preferences, you need massive context windows.
And a context window isn't just a clever software trick, It's not something you can just fix by writing a script that saves a text file to a hard drive.
Right.
To have an AI model actually reason about your past conversations, it has to hold all of that data in its active compute space simultaneously.
So it's the difference between having a book on a shelf versus having the book open on your desk right in front of you.
That is a great way to think about it. And expanding that desk space requires an unimaginable amount of physical memory. Random access memory, or RAM. While software problems can often be solved by throwing smart engineers at them, the sources mention teams building completely proprietary file systems to optimize how data is recalled. Physical hardware constraints cannot be bypassed.
You literally need the chips.
You can write the most efficient code in the world, but if you don't have the physical memory chips, the agent still gets amnesia.
So that's why memory prices are surging. It explains why companies that manufacture memory, like Micron and SK Hynix, are being viewed as critical bottlenecks. It's not just about the processors calculating the math, it's about the memory holding the conversation.
AI essentially equals memory at this point. Until that physical manufacturing bottleneck is solved, the hardware factories dictate the pace of the software innovation.
Okay, so we've got this intelligence that's getting cheaper, but it's constrained by very expensive physical hardware.
Right.
I want to look at what happens when this intelligence actually leaks out into the physical world. The sources talk about Travis Kalanick, the founder of Uber, who has been running a stealth company called Cloud Kitchens.
Yeah, he's been quietly building this for years, and the underlying philosophy is quite profound.
It blew my mind. The sources say he is essentially taking the architecture of computer networking, the exact same TCP/IP logic that routes data across the internet, and he's mapping it onto physical logistics. So he treats a ghost kitchen like a manufacturing node. And he treats a burrito delivery the exact same way a computer scientist views a packet of data being routed across a network.
It's systems thinking applied to the physical world.
Wait, help me visualize this. Is he literally treating a slice of cheese or a delivery driver like a line of code?
Functionally, yes. In a computer network, a router looks at a packet of data, assesses the fastest possible path to its destination based on current traffic, and sends it. Kalanick is breaking down every single component of a restaurant. Real estate, food prep time, driver location, traffic patterns. And he's using AI to route the physical goods just as efficiently.
And it doesn't stop at software routing. He's actively integrating physical robotics to drive the cost of labor inside those kitchens down, which brings up an interesting debate in the robotics world from the sources.
Right.
Everyone is obsessed with humanoids right now, like the Tesla bot.
The humanoid form factor captures the public imagination, certainly. It's very sci-fi.
But Kalanick made this incredible observation. He was watching a video of humanoid robots running a marathon in China, and his only thought was, why don't they just put wheels on them?
It exposes a massive human bias. We are constantly trying to recreate ourselves.
Yeah.
But humans are actually only good at general purpose, low volume work. We can flip a burger, mop a floor, and carry a box all decently well. But if you want to optimize a specific task, the humanoid form is incredibly inefficient. Balancing on two legs is a computational nightmare. The future of physical AI, at least in the logistics sense, is highly specialized, high-volume robots.
So what does this all mean? If we have AI software driving down the cost of intelligence and specialized robots driving down the cost of physical labor and logistics, where does that leave the economy?
The sources referred to this as the deflationary endgame, or the potential end of capitalism as we currently understand it.
Right.
If you remove the cost of labor and the friction of logistics, the marginal cost of creating and moving goods plummets towards zero. We enter a world of abundance.
I want to push back on that a bit, though. People have been screaming about the end of capitalism since the cotton gin. Isn't this just automation 2.0? Why is this time actually different?
Because previous automation replaced muscle. This replaces muscle and cognitive reasoning simultaneously. If intelligence is essentially free and labor is automated, the traditional moats that companies rely on to protect their profit margins completely evaporate.
Right. If anyone can spin up an automated kitchen with a specialized robot, how do you defend your business model?
You can't. Which brings us to the most jarring part of our source material today. We've been talking about this beautiful deflationary future where robots make everything cheap.
Yeah.
But the data from 42 Macro throws a massive bucket of cold water on the AI party. I'm looking at this data and my head is spinning. If AI is going to make everything cheaper, why on earth are global bond yields surging to highs not seen since the 2008 financial crisis? Why is money getting more expensive?
If we connect this to the bigger picture, it comes down to a structural tug of war for a very limited pool of global capital.
Okay, walk me through this tug of war. Who is pulling on the rope?
On one side, you have the AI revolution, which requires trillions in upfront capital expenditure, as we discussed with Google's data centers.
Right.
On the other side, you have wide, persistent global fiscal deficits.
Meaning governments are spending way more money than they actually collect in taxes. Exactly that. We are shifting into a multipolar world. Governments everywhere are spending massively on defense and physical infrastructure to secure their own supply chains.
Yeah.
So you have the AI capex bubble competing directly with sovereign governments for the exact same pool of capital.
And the data from 42 Macro spells this out clearly. Global nominal GDP growth is structurally elevated. It came in at 6.7% in the first quarter. To put that in perspective for you, the historical trend prior to 2008 was around 5 to 6%, and between 2015 and 2019, it was only 4.9%. So the economy is running extremely hot.
But here's the problem. While growth is high, global savings growth is structurally depressed. It is among the lowest on record.
Wow.
You have high demand for capital to fund this growth, but a shrinking supply of savings to draw from.
Which leads to this terrifying statistic. The combined cost of equity and debt capital is currently below its long-run mean in major markets.
Yeah.
In the U.S., the current cost of capital is 4.13%, but the historical mean is 4.46%. I need you to translate that for me. What does it actually mean when the cost of capital is below its mean?
It means investors are systematically underpricing risk.
Okay.
When capital is scarce, as it is now, with low savings and high deficits, the cost to borrow that capital should be high, but it's artificially low right now. Investors aren't demanding enough reward for the risk they are taking.
I see.
Eventually, reality sets in, and they will demand higher returns. In finance, we say risk premia must rise.
Wait, in plain English, does risk premium just mean the extra compensation I demand for taking a bet that might blow up in my face?
That is the perfect definition. And when risk premia rise rapidly, asset prices generally fall to adjust to that new reality. Which brings us to the volatility signals that 42 Macro focuses on heavily.
Right, the options data.
They highlighted the MVE index, which recently hit a 2-month high and is breaking out.
Now, I know the VIX is the fear gauge for the stock market. Is the MVE index just the fear gauge for the bond market?
It's the premier gauge for bond market volatility, yes. But it goes deeper than just a fear gauge. This is where we really need to look at what implied volatility and options flow actually reveal about expected market moves.
I always get lost when we start talking about options flow. How does an option contract tell us what the entire market is going to do?
Think of the options market like a massive insurance market for institutional investors.
Okay.
When you look at the flow of money in options, you are seeing where the smartest players are placing their leveraged bets to hedge their portfolios. Implied volatility is basically the premium they're willing to pay for that insurance.
So if implied volatility is spiking, the insurance is getting really expensive.
Exactly. When implied volatility in the bond market spikes, it tells us that massive institutions are buying up insurance because they expect violent, unpredictable swings in the price of money itself.
Oh, wow.
Options flow shows us that dealers are being forced to hedge against huge tail risks. They aren't just protecting against a small dip, they are preparing for major macro turbulence.
So it's like a game of musical chairs. But instead of taking away one chair, the government and the AI companies are suddenly grabbing all the chairs at once. And these institutional investors are buying options because they know they are going to be left standing when the music stops.
That analogy is remarkably accurate. Bond volatility acts as a countercyclical leading indicator for global liquidity.
Okay, you're going to have to unpack countercyclical leading indicator for me.
It means that when bond volatility goes up, the amount of cash freely flowing through the financial system goes down.
Oh.
The plumbing gets clogged. When volatility is high, banks and institutions have to hoard cash to protect their balance sheets. They stop lending. Balance sheet capacity just shrinks.
Which raises the acute risk of a summer 1998-style market correction. The sources mention 1998 specifically. For those who remember, that was when a massive hedge fund called Long-Term Capital Management collapsed.
It was a massive liquidity event, and the sources note that during that crisis, correlations went to 1.
I see that phrase in financial research all the time.
Yeah.
Correlations went to 1. Explain that to me like I'm a 5-year-old.
Normally, we expect cross-asset correlations to be diversified. If stocks go down, maybe bonds go up or gold goes up. They are uncorrelated.
Right, the whole point of a diversified portfolio.
Exactly. But when a true liquidity crunch hits and a massive institution gets a margin call, they can't choose what to sell based on a clever strategy.
Because they just need cash.
They have to raise cash immediately, so they sell everything. Stocks, bonds, gold, real estate, everything crashes at the exact same time.
Wow.
That is what correlations going to 1 means. The cross-asset correlation becomes a perfect 1.0. You don't sell what you want to sell, you sell what you can sell. And the options market data is currently hinting that investors are quietly bracing for that kind of environment.
Wow. So the stark warning that before we reach this promised land of AI abundance and cheap burritos, we might have to survive a brutal capital crunch where the cost of money violently reprices upward.
Yeah, and that stress on the legacy financial plumbing is exactly why the sources spend a good amount of time discussing how crypto fits into this multipolar, capital-starved world.
Right, they discussed the Clarity Act in Washington. And I have to say, it feels a bit like political theater.
How so?
Well, assets like Bitcoin operate on decentralized networks. A blockchain doesn't care what a piece of paper in Washington says. It's just going to do what it does.
You're right that the protocol itself doesn't care about the law, but a trillion-dollar pension fund certainly does.
Oh, good point.
Regulatory clarity might be performative for the technology itself, but it is absolutely essential for traditional Wall Street to enter the space safely. A major investment bank cannot allocate billions of dollars of institutional capital without clear legal guardrails.
That makes a lot of sense. And the sources point out a really interesting shift in where that institutional capital wants to go. The market focus seems to be moving away from Bitcoin as a pure digital gold asset play and moving much more toward Ethereum.
Because Ethereum represents something Wall Street fundamentally understands: revenue potential.
Right.
It operates more like a digital economy with programmable cash flows. And even more importantly, the focus is shifting to the infrastructure of stablecoins.
The stablecoin aspect is huge. The sources argue they are rapidly replacing the SWIFT system as the preferred global financial plumbing.
Yeah, they really are.
In a multipolar world where countries are worried about being sanctioned or frozen out of the traditional dollar system, stablecoins offer a way to transact in U.S. dollars on a neutral, internet-native rail.
It's the digitization of the dollar. happening entirely outside the traditional banking system. And traditional finance is waking up to this reality.
Yeah.
Look at the sources mentioning PayPal merging its consumer base with crypto rails.
Right.
They see that the underlying technology of moving money is fundamentally changing.
But despite all this massive institutional movement in infrastructure building, retail investors are basically asleep at the wheel. The sources did a quick sentiment check using Dogecoin.
Dogecoin, right?
Dogecoin has been struggling just to break its 20-day moving average. Why does a meme coin matter to macro analysis?
Because it is a classic technical indicator of retail apathy. Dogecoin is driven almost entirely by retail sentiment.
Okay.
If it is struggling to break a basic moving average, it tells you that everyday investors are still sitting on the sidelines. They aren't paying attention to the plumbing or the structural shifts. They're just waiting for a price chart to trend up.
Which feels like a mistake. Because the structural changes happening right now are moving faster than most realize.
We are watching the foundation of the global economy being ripped out and replaced in real time.
It really is incredible. So let's take a breath and recap the massive amount of ground we've covered today.
Let's do it.
We started with the realization that the race for artificial general intelligence isn't waiting on a magical new microchip. It's waiting on hundreds of billions of dollars in capital.
Right.
We looked at how AI is currently trapped in a 51st states amnesia cycle because it takes a staggering amount of physical RAM to hold a context window open.
We then explored how that intelligence is inevitably leaking into the physical world, applying internet routing protocols to ghost kitchens, and sending specialized wheeled robots to disrupt physical labor.
And then we collided all of that futuristic optimism with the cold, hard reality of the global bond market. The options market and the MBV index are flashing red, warning us that the tug of war for capital between AI dreams and massive government deficits might trigger a 1998-style liquidity crunch where correlations go to 1.
Yeah.
All while stablecoins are quietly rewriting the rules of global finance in the background.
It's a lot to synthesize, but it brings up a massive structural issue that goes beyond just investing. We talked about how specialized robots and AI will eventually drive the cost of labor and goods towards zero.
Right, the deflationary endgame.
But think about the other side of that equation for a second. If human labor is systematically replaced by specialized robots and traditional corporate profits evaporate because intelligence is free, who pays the taxes? Earlier, we talked about these massive, persistent government deficits. Governments fund those deficits primarily through income tax and corporate tax. If human income drops and traditional corporate moats disappear, how does a sovereign nation actually fund itself?
Do we start taxing algorithms?
Exactly. Do governments place a levy on the size of your AI's context window?
Oh.
Or do we tax the robots based on their computational output? It fundamentally breaks the current model of the nation-state. Think about that next time you see a robot running a marathon.
Here's where it gets really interesting.
Yeah.
Keep learning, keep questioning, and we'll catch you on the next deep dive.